This is the story of how the United States captured a foreign president to secure access to the world's largest oil reserves while defending the dollar's dominance in global energy markets. American forces extracted Venezuelan President Nicolás Maduro on January 3, 2026, in what President Trump called a large-scale strike, and within hours, the administration announced plans for US oil companies to invest billions in Venezuelan infrastructure. The numbers behind this operation reveal an economic calculation that goes far beyond regime change, making it the most economically explicit American intervention in decades. Venezuela sits on top of 303 billion barrels of proven oil reserves, the largest in the world and exceeding even Saudi Arabia's 267 billion barrels. That's roughly 17 to 18% of all proven global oil reserves. For over a decade, those reserves have been both inaccessible to American companies and increasingly sold outside of dollar-denominated markets, too. Conditions. The January 2026 operation appears designed to reverse simultaneously. Understanding why the United States would conduct a military operation this consequential requires understanding just how catastrophic Venezuela's economic collapse actually was, how that collapse created the intervention window, and why Venezuelan oil sales outside the dollar system represented a threat the US ultimately couldn't tolerate. Venezuelan GDP contracted approximately 74% between 2013 and 2025. This wasn't a recession or even a depression in the traditional sense. This was the largest peacetime economic collapse in modern recorded history, worse than the Soviet Union's dissolution, worse than Greece during the debt crisis, worse than any economy not actively at war. Oil production numbers tell the story. Venezuela pumped 2.5 million barrels per day in 2013, but by 2020 that number had plummeted to just 544,000 barrels per day, a decline of nearly 80%. Production recovered, partially to around 950,000 barrels per day by late 2025, but that still represents only about 25 to 30% of the country's theoretical capacity. The human cost quantifies the catastrophe in ways GDP numbers can't capture. Hyperinflation peaked at 130,000, 60% in 2018. The currency required 3 separate redenominations that collectively removed 14 zeros, and by 2021, between 94 and 96% of Venezuelans lived in poverty. The basic food basket cost 250 times the minimum wage. Between 7.7 and 8 million Venezuelans, roughly 1/4 of the entire population, fled the country in one of the largest displacement crises in modern history outside of active war zones. What caused this implosion remains contested. Venezuelan mismanagement began well before comprehensive US sanctions, starting with the 2002 PDVSA strike that resulted in 18,000 worker dismissals. Widespread nationalizations throughout the 2000s drove out foreign investment and technical expertise, and the 2014 oil price crash devastated an economy that had become almost entirely dependent on petroleum exports. But US sanctions clearly accelerated the collapse. January 2019 brought the Trump administration's designation of PDVSA, Venezuela's state oil company, freezing $7 billion in US-based assets and effectively cutting Venezuela off from American refineries that had been specifically built to process Venezuelan crude. Production declined 59% in the year following that designation alone. This created what economists call a dual causation debate, where the question becomes whether Venezuela's collapse came primarily from Maduro's economic incompetence, or whether sanctions turned a crisis into a catastrophe. The Government Accountability Office confirmed that sanctions likely contributed to Venezuela's economic deterioration, but couldn't quantify the exact split between internal mismanagement and external pressure. For the purposes of understanding the 2026 intervention, the cause matters less than the effect. By early 2026, Venezuela was producing less than 1/3 of its capacity, its government was internationally isolated, its currency was worthless, and roughly 80% of its remaining oil exports were flowing to China at steep discounts. That created an opportunity. The economic isolation of Venezuela represents one of the most comprehensive sanctions campaigns ever implemented against a petroleum state. Beyond the $7 billion in frozen PDVSA assets, international banks hold an estimated $8 billion in seized Venezuelan funds. and the United States, United Kingdom, and Portugal collectively blocked approximately $6 billion in foreign assets, according to UN Special Rapporteur Alina Dohan. Frozen assets represent only a fraction of the economic impact. One estimate calculated $226 billion in foregone oil revenue between January 2017 and December 2024, roughly $77 million per day in lost revenue over that 8-year period. To put that number in context, PDVSA's oil exports in 2019 totaled $16.4 billion, but by 2022, oil exports had collapsed to just $495 million, a 97% decline in 3 years. Whether that $226 billion represents losses from sanctions or losses from sanctions combined with mismanagement depends on your analytical framework, but the magnitude is undisputed. Banking restrictions created cascading failures throughout the Venezuelan economy. All 9 USAID implementing partners reported that financial institutions closed accounts or rejected transactions due to what's called sanctions over compliance, where banks simply refuse any Venezuela-related business rather than risk potential penalties. Even humanitarian transfers face delays or outright rejections as banks practice blanket de-risking for anything connected to Venezuela. When the Central Bank of Venezuela received its designation in April 2019, foreign exchange operations stopped entirely. This wasn't just about oil sales, it meant Venezuela couldn't process routine international transactions, couldn't access international banking systems, and couldn't participate in dollar clearing networks that handle the vast majority of global trade. This brings us to the petrodollar system itself and why Venezuela's attempts to exit that system may have ultimately sealed Maduro's fate. The petrodollar system emerged from a specific 1974 agreement where Saudi Arabia agreed to price all of its oil exports exclusively in US dollars in exchange for American military protection. Other OPEC members followed, and the result was a system where any country wanting to buy oil, the world's most traded commodity, needed to hold dollars to complete those transactions. This creates what economists call structural dollar demand. Even if a country doesn't trade with the United States directly, it needs dollars in reserve to purchase energy, and this arrangement enables America to run persistent trade deficits without the currency devaluation that would normally result because global demand for dollars remains constant regardless of US fiscal policy. The dollar today comprises 57% of global foreign exchange reserves, down from 65% in 2016, but still representing dominant market share. This dominance powers America's sanctions architecture, where the ability to cut countries off from dollar clearing systems is only effective because those systems handle the majority of global transactions. The petrodollar system also means the United States can finance its government debt at lower interest rates than would otherwise be possible. When global central banks need to hold dollars for energy purchases, they typically hold those dollars in US Treasury bonds, creating constant demand for American government debt regardless of US fiscal conditions. Historical patterns suggest petroleum states that attempt to exit dollar-denominated oil sales face extraordinary consequences. Iraq switched to euro-denominated oil sales in November 2000, and regime change followed within 3 years. Libya's Muammar Gaddafi proposed a gold-backed African currency for oil transactions in 2009, and NATO intervention occurred in 2011. Iran has sold oil in non-dollar currencies since 2012 and faces continuous pressure. Whether correlation implies causation in these cases remains hotly debated, but the pattern is observable where major petroleum exporters that attempt to bypass dollar markets tend to face significant geopolitical pressure shortly thereafter. Venezuela didn't just theoretically threaten the petrodollar system, it actively worked to circumvent it. President Maduro began pricing Venezuelan oil in Chinese yuan rather than dollars in September 2017, and by October 2018, government foreign exchange auctions quoted euros, yuan, and other currencies instead of dollars as the primary reference. More significantly, Venezuela structured $60 billion in Chinese oil for loans arrangements that bypassed dollar settlement entirely, where China would provide financing and Venezuela would repay in oil shipments priced in yuan or through direct barter arrangements. These weren't small side deals, they represented the bulk of Venezuela's international financing during the peak sanction years. Venezuela also launched the Petro cryptocurrency in February 2018, the first state-backed attempt to create a sanctions-proof digital currency specifically for oil transactions. While the Petro ultimately failed technically and shut down in January 2024, it represented a direct challenge to dollar-based oil pricing with a clear message that Venezuela was actively seeking mechanisms to sell oil without touching dollar clearing systems. This is where Venezuela's position became uniquely threatening from a petrodollar perspective. Saudi Arabia has comparable reserves and remains a US ally. Many countries maintain relationships with American rivals without facing intervention, but Venezuela represented the combination of the world's largest proven reserves, active de-dollarization efforts, deep Chinese financial integration, and collapsing production that created potential for massive recovery once sanctions lifted. If Venezuela successfully demonstrated that a major petroleum exporter could operate profitably outside dollar markets while expanding production and market share, it would provide a template for other oil exporters to follow. Unlike previous interventions where resource motivations remained officially unstated, the Trump administration articulated its economic objectives directly. Hours after Maduro's capture, President Trump announced that we're going to have our very large United States oil companies go in, spend billions of dollars, and fix the badly broken infrastructure. Stephen Miller, a senior Trump advisor, characterized Venezuela's 1970s and 2000s nationalizations as the greatest theft of American wealth, and framed the intervention explicitly as recovering American oil company assets and access. Secretary of State Marco Rubio noted that American refineries along the Gulf Coast are the best in terms of refining the heavy crude that Venezuela produces, a direct acknowledgement that Venezuelan oil has specific value for US refining infrastructure. The investment opportunity is substantial. Energy analysts estimate $80 to $90 billion would be needed to restore Venezuelan production to 2010 era levels of 2.5 million barrels per day, including $58 billion required just for pipeline updates that haven't occurred in 50 years. Full recovery to theoretical capacity of 3.5 to 4 million barrels per day could require over $100 billion in investment over a decade, representing one of the largest oil infrastructure reconstruction projects in history and comparable in scope to the post-World War II reconstruction of European petroleum facilities. Chevron, the only remaining US. Major operating in Venezuela currently produces approximately 150,000 barrels per day, about 25% of Venezuela's total current output. Under General License 41 issued in November 2022, Chevron was allowed to resume operations that had been frozen, demonstrating the commercial viability even under sanctions. And ConocoPhillips holds over $10 billion in nationalization claims that it may seek to recover through re-entry into Venezuelan operations. The strategic logic aligns Gulf Coast refinery infrastructure with Venezuelan crude characteristics. American refineries were specifically designed to process Venezuela's heavy, sour crude, making it a better technical match than domestic light, sweet shale oil, or Canadian heavy crude alternatives, and decades of infrastructure investment optimized US refining capacity for exactly the type of oil Venezuela produces in abundance. While Venezuela collapsed and the United States tightened sanctions, one country benefited enormously. Beijing became Venezuela's dominant oil customer, receiving approximately 746,000 barrels per day by 2024, roughly 80% of Venezuelan oil exports. These purchases occurred at steep discounts, often 20 to 30% below market rates, through what's known as a shadow fleet of tankers that relabel Venezuelan crude as Malaysian to evade tracking and sanctions enforcement. Since 2007, China invested over $60 billion in Venezuela through the oil for loans arrangements we mentioned earlier, and by 2024, these deals meant China had secured preferential access to the Western Hemisphere's largest oil reserves while conducting the entire relationship outside dollar markets, exactly the scenario American strategists have sought to prevent since the Cold War. China also controls over 90% of global rare earth refining capacity, while simultaneously embedding itself in Venezuelan mining operations that produce critical minerals used in advanced weapon systems. This represents strategic resource integration that extends beyond petroleum. Canada partially filled the gap in US oil supply chains, with Canadian heavy crude exports to America increasing from 2.7 million barrels per day in 2013 to nearly 4.4 million at peak. However, Canadian reserves total 168 billion barrels, large but still only about half of Venezuela's $303 billion, and extraction costs for Canadian oil sands are substantially higher than conventional Venezuelan drilling. Redirecting Venezuelan oil from China to US refineries would simultaneously improve American energy security and increase Chinese energy vulnerability, forcing China to seek alternative suppliers at higher prices while giving the United States preferential access to reserves in its own hemisphere. From a pure geopolitical resource competition perspective, the calculus is straightforward. Economic analysts remain divided on whether this intervention represents rational resource policy or costly overreach, where the arguments on both sides rely on the same facts but draw different conclusions about costs, benefits, and execution risk. Proponents argue that Venezuelan crude sold at market prices could triple current revenue compared to the discounted Chinese purchases. They note the humanitarian crisis, 7.8 million displaced, 94% poverty rates, hyperinflation above 130,000% occurred under Maduro regardless of whether the United States intervened. Infrastructure rehabilitation would create American jobs, optimize existing Gulf Coast refinery capacity, reduce reliance on Canadian suppliers, and deny adversaries a Western Hemisphere foothold. The petrodollar defense argument notes that if Venezuela successfully demonstrated large-scale oil sales outside dollar markets while expanding production, it would provide a working model for other petroleum exporters to follow, potentially accelerating the dollar's decline from 65% to 57% of global reserves and beyond. Critics counter that sanctions demonstrably accelerated Venezuela's collapse, where the 59% production decline in the single year after January 2019 PDVSA sanctions is difficult to attribute to anything but the sanctions themselves. They argue that Venezuela's post-sanction survival with Chinese backing actually proves petrodollar circumvention is possible, making the intervention potentially self-defeating as a dollar defense strategy. The economic warfare approach, critics note, fit the definition of collective punishment according to one controversial but widely cited Center for Economic and Policy Research study, with 40,000 deaths potentially attributable to sanctions between 2017 and 2018 alone. The cost-benefit calculation depends heavily on timeframes and assumptions. Short-term costs include regional instability, refugee flows that affect neighboring countries, direct military expenses, and potential resistance or insurgency, while long-term potential benefits include access to 303 billion barrels of reserves, reduced Chinese energy leverage, dollar system reinforcement, and integration of Venezuelan crude with US refining infrastructure. But those benefits only materialize if post-capture governance succeeds, a highly uncertain variable. Trump simultaneously captured Maduro while dismissing opposition leader Maria Corina Machado as lacking respect within the country, suggesting uncertainty about who would actually govern Venezuela going forward. Several statistics anchor any economic interpretation of this intervention, regardless of whether you view it as justified or reckless. 303 billion barrels of proven reserves, 17 to 18% of the global total. That's the prize. A 78% collapse in production from 2.5 million barrels per day at peak to 544,000 at the bottom demonstrates both the damage done and the recovery potential. $226 billion in estimated foregone revenue between 2017 and 2024 quantifies the sanctions impact at a scale of $77 million per day. The petrodollar's gradual erosion from 65% to 57% of global reserves provides context for American sensitivity to any petroleum exporter attempting dollar exits. China's $60+ billion investment in Venezuela, largely outside dollar markets, demonstrates the alternative system already taking shape. And Trump's stated goal of US companies investing billions to fix Venezuelan infrastructure within hours of capturing Maduro makes resource acquisition an explicit rather than implied motivation. The capture of Nicolás Maduro represents perhaps the most economically explicit US military intervention in modern history. Unlike Iraq or Libya, where resource motivations remained officially unstated even when widely suspected, The Trump administration articulated oil infrastructure investment and dollar market protection as primary objectives within hours of the operation. Venezuela's unique position created an alignment of economic factors that appear to have driven the intervention decision, combining the world's largest oil reserves, collapsed production, creating enormous upside potential, active de-dollarization efforts that threatened the petrodollar system, and deep Chinese economic penetration in America's own hemisphere. The petrodollar preservation thesis finds substantial circumstantial support in the historical pattern of pressure against petroleum states attempting dollar exits. Whether Venezuela's yuan-priced oil sales and cryptocurrency experiments directly caused the intervention remains debated, but the Trump administration's explicit statements about fixing oil infrastructure and the timing of the operation leave little doubt that petroleum economics drove the decision. What happens next depends entirely on execution. The economic logic is coherent. Redirect 303 billion barrels of reserves away from discounted Chinese purchases back to US refineries. Restore production through massive infrastructure investment and reinforce dollar-denominated oil markets by bringing the world's largest reserve holder back into the traditional system. But economic logic and successful execution are different things. Venezuela now faces the same question Iraq faced after 2003 and Libya faced after 2011, whether military intervention can successfully create the stable governance needed to rebuild petroleum infrastructure, or whether regime change creates power vacuums that prevent the economic benefits from ever materializing. The US just conducted the most expensive bet in the history of the petrodollar system. Whether that bet pays off won't be known for years, but the cost of being wrong is already visible in 7.8 million Venezuelan refugees, a 74% economic collapse, and the largest peacetime humanitarian crisis in the Western Hemisphere's modern history. The question now is whether America can fix what a decade of economic warfare destroyed, and whether fixing it was the goal all along.